Nexus Inc.
My name is David, I'm the CEO.
My name is Guadalupe Diaz and I'm the CFO.
I'm Miriam Hernandez and I'm COO.
I'm Divata Shube, I'm CMO.
I'm Michael Cable, I'm the CAO.
I'm Dewan, I'm the CSO.
A quick overview. We've gone over the corporate charter. We will also go over the financial targets, industry analysis, the financial statement analysis, company comparison, and finally we'll go over the goals for the future of Nexus Inc.
I'm Divata Shube, I'm the CMO. I will be talking about the financial objective of Nexus Incorporation, which is our company, the leading company. So for the target of year 6 and 5, for the return on asset, our target was 5.7 and the actual was 13.1. And for year 6 is 7.27 as the target and the actual was 23.63. You guys can see that here we were above our expectation, above the target. For the ROE, the target is 8.5% and the actual is 22.57. And the target for year 6 is 9.15% and the actual is 52.83. Once again here for the ROE, our company is above the expectation, above the target. For the market share, the target is 24% for year 5 and the actual was 23.5%. And for year 6 is the target is 24% and the actual is 22%. Just for the market share, for year 5 we were a little below the expectation, and for year 6 we are much lower than year 5. So our company did not do that well in the market share. Both for year 5 and year 6, it's just below our expectation. For the stock price, for the target is 5.90 and the actual was 2.11. And for year 6, the target is 15.90 and the actual is 4.34. Our company did not do well in year 5 and year 6 with the stock price. It's way below our expectation, especially in year 6. For the unit cost, the year 5, the expectation was 5.56 and the actual is 5.25. And year 6, the projected was 6.36 and the actual was 4.60. For the unit cost again, here our actual was much lower, especially in year 6. And finally for the net income, the target is 5 million and the actual was 2,405,000. And the target for year 6 is 7 million and the actual for year 6 is 3,505,000. And for the net income, we can see that our expectation, we had higher expectation, but the actual was much lower. Here is kind of half of it. We just made almost half of it in year 5, and in year 6 too, almost half of it.
Hi once again, so remember I'm the CSO of the company, and I've been introducing some of the industry analysis, trying to keep it short though, with ROA numbers, ROE, the MS, SP, UPC, and TNI. This will be the main 6 weighting factors. Starting with the ROA, we have company 1, 2, 3, 4, 5, that's the industry's main players. For the ROA, we have 13.10%, ROE 22.57%, market share would be 22.12%, and stock price was 211. That's for year 5, by the way. Unit production cost will be 5.25. All these factors are really important to figure out what the company is all about and how well has it done. Our company has done actually really well, and just the table itself is really self-explanatory if you look at the industry numbers as an average. So for our ROA, we have 2.10 with an industry average of 10.82%. Same thing with the ROE. We have industry average being 16.43%, and our number is 22.57%. As for market share, the industry average is 20.07%, and we have 22.12%. For the stock price, the average industry is, for all the companies, average industry stock price was 1.67, and our stock price was 2.11. For the unit production cost, as you can see off of these numbers here, for all the companies, we have the lowest unit production cost. And as for the industry average, we have 6.05. For the net incomes, for year 5, we have 2,405,000. And as you can see, all the other companies are lagging behind. We just have company 5 that had more net income. As for the industry's average, we have 1,847,000. If you could just go to year 6 now. Okay, same picture here. We have ROA is 24.37% compared to industry's average, which is way low, it's 6.67%. Same thing for ROE, 52.83%, which is the highest number in here. As you can see, company 4 is a negative number. And we have the industry average being at 7.99%. We have the market share, which is 24.57%, which increased from, I believe, from year 5, from 22% to 24.57%. And industry's average is 20%. The stock price increased from if you could just go back to year 5 quickly. Okay, stock price was from 2.11. Can we just go back to year 6? Okay, to 4.34. We have the industry's average being 2.71. And then unit production cost has also increased. Where you have the industry's average being 6.53, which has increased compared to year 5. And for net income, we have some negative numbers for companies 1 and 4, and our net income has actually increased to 3,505,000. And I'm going to go ahead and pass.
Okay, I'm going to go over the income statement, and as you can see, our actual numbers are lower than the forecasted. For sales, we only did $31 million in year 6 compared to the forecast 46. We expected higher sales since we did our forecast based on our year 3 and 4. We were taking first place, and so it went a little lower, but the total industry average was only $23 million. So we did pretty well. We did 35% higher than the total average industry. Also, everything affects, all the balance sheets affected by the sales. If you look at the cost of goods sold is a lot higher by 30%. And the reason is a lot lower is because we invested money in a $1.5 million plan in Sereno, and that drove our unit price cost very low, and so that's the reason why you see 32% decrease. And again, we look at our gross profits, it's 29% because we only had actual profit of 17 million compared to 25 million in our forecast. Another factor that was really affected in the income statement is since we didn't make our sales, we decided to cut some of our expenses. For instance, if you see sales commission, we only actually pay out 1 million compared to 1.7 million as forecasted, which it gives us a difference of 35%. Another important factor is our net profit. It has, our actual was 3.5 million in year 6, and our forecasted was 6.7, and again, it was mainly affected by our sales, which is a difference of 48% variance. Now we're going to go over our balance sheet. We have our assets, and the actual was 1.6 million. Our forecast number was 3.5, which it gives us a variance of 55%. And the main reason for this is because we didn't get the sales that we expected. That was one of the main reasons. Another reason for this is that we decided to invest in another plant in Sereno to lower our cost of goods sold. And we also pay out dividends in year 6, so that went down in our cash balance. As you can see also, accounts receivables, we expected 6.5 million and the actual number is only 4.3, which is a 34% variance. And as you know, all of our sales were on account, and since we didn't meet our sales goals, it was directly affected our accounts receivables. Another important factor is actually our accounts payable. Our accounts payable the actual was 1.9 compared to 3.2. Since we didn't have the sales as expected, we were really concerned about the way we spend money, and we used our cash instead of our credit. And that's pretty much the summary of the balance sheet.
Okay, so now we're going to take a look at return on equity, company comparison. As you can see, in the end, we were ahead of all the companies at roughly 20%. Our only competition was company 5 at around 17%. And as you can see here, company 1, 3, and 4 did not fare as well. We can attribute most of our success here on return on equity is attributed to steady stock price throughout the year, as well as throughout the years, and that's return on equity. Okay, so now we're going to talk about market share. As you can see, company 2, which is a Nexus company, we came in a close second at 22%, with company 5 very narrowly beating us at 23%. We think that most of our success from our market share came in the form of net sales, because we were able to consistently meet high sales numbers throughout the years. We were able to maintain a steady market share. Okay, so now we're going to talk about stock price. Again, we're going to compare it to the other companies. Nexus company, we led with $2.68 per share, with company 5 coming in second place at $2.67 per share, which is obviously a narrow margin. However, we attribute our stock price, our high stock price, being the fact that we were a steady company and we were an attractive stock, which allowed us to maintain a high stock price. My name is David. I'll be going over our unit production costs. As you can see, we have the lowest unit production cost out of all the companies. Our unit production cost was $5.06, while company number 4 had the highest with $6.82. And this is thanks to our production overseas and our continuous push for employee training. Okay, and I'll also be going over the total net income for all the companies. As you can see, we got second place with a total net income of about 8.6 million, while company number 5 led with about 10 million. And our success in net income is thanks to our overall unit production costs, our very low operation costs, and a very good sales team.
So future goals for Nexus Inc. We want to still focus on strategy, definitely focusing on market share and increasing that. We want to provide more training for our management personnel. We also want to focus on finance by having more cash on hand for any kind of expense. No bank loans, we don't need a higher interest, and definitely more money into investing. For our marketing plans, we want to definitely continue our marketing campaigns and perhaps receive consumer reports at an earlier time to definitely give the clients, the customers, what they want. Finally, for operations, we want to move production to overseas so we can continue operating at a lower expense. Thank you for tuning in. tuning into this report. On behalf of Nexus Inc. and its management, we'd like to thank you for making our group #1 in sales.
And please continue to buy our product.